Hello and welcome to Forex Kamai. I am your host Salman, and in this video we will provide a step-by-step guide for beginners on how to trade Forex. Step number 1 is to learn the basics. For the basics, you need to watch the video about what is Forex by clicking at the right top of the video. And once you are familiar with the basics, the next step is to research and choose a reputable Forex broker that is regulated by a financial authority. A Forex broker is a financial service company that provides traders access to the platform for buying and selling of the foreign currencies. A regulated broker is one whose activities are monitored and controlled by a local regulatory authority to prevent any fraudulent activities or excessive risk-taking by the broker. On the other hand, unregulated Forex brokers are those based in offshore countries that have far fewer laws governing broker activities. Step number 3 is to open a Forex trading account with a chosen broker. For this, you will need to provide some personal information to get your account set up. Step number 4 is to fund your account with a deposit. A Forex broker offers several deposit options which you can choose to fund your account. Step number 5 is to download and use a trading platform provided by the broker. Now that you are done with opening your account and funding it, you need a trading platform to execute or perform trades. The broker provides access to the market, while the trading platform allows you to analyze quotes and perform trades. MetaTrader 4 and MetaTrader 5 are popular trading platforms used by many Forex traders. Step number 6 is to log in to the platform using the account details provided by the broker. Now that you have downloaded the trading platform, MT4, MT5 or any other, you need to log in using the account information provided by the broker. After selecting the server and putting in the login username, you need to put the password that you set for your trading account to log in to the trading platform. The last and the 7th step is to familiarize yourself with the trading platform and how to place trades. And once you feel confident, you can start trading with the real money. But before we start trading with the real money, let's learn some of the trading basics. Trading in the Forex market is done in lots. When you go to a grocery store and you want to buy an egg, you can't just buy a single egg. They come in dozens or lots of 12. In Forex trading, a lot refers to a standardized trading size. For example, if you are trading Euro USD currency pair and you want to buy one standard lot, you are buying 100,000 euros and selling an equivalent amount of US dollars. Other lot sizes in the Forex trading include mini lots, that is 10,000 units of the base currency, and micro lots, that is 1,000 units of the base currency. Now we will discuss about pip. Pip stands for percentage and point, and it is the smallest unit of price movement in the Forex market. Pip is also known as a point, and it represents the 4th decimal place in most currency pairs. For example, if you are trading Euro USD pair and the current price is 1.1000 and it moves to 1.1001, this means that it has moved 1 pip. Pips are important in the Forex trading because they determine the profit and loss of a trade. Now let's jump to how brokers will quote you the price of the currency. Forex brokers will quote you two different prices of the currency pair, the bid price and the ask price. The bid price is the price at which you can sell the base currency, and the ask price is the price at which you can buy the base currency. The difference between these two prices is known as spread. Now, looking at the example, the bid price for Euro USD is 1.1051, whereas the ask price for Euro USD is 1.1053. So the difference between these two is the spread, which in this case is 2 pips. This spread is the fee for providing transaction immediacy. This is also called transaction cost. The spread is how no commission brokers make their money. Now, spreads are generally classified into two categories: fixed spreads and variable spreads. Fixed spreads are the spreads that do not change regardless of the market conditions. This means that the difference between the buy and the sell price remains constant, and the trader always knows the exact cost of their trade. For example, a broker might offer a fixed spread of 2 pips for Euro USD currency pair. This means that the spread will always be 2 pips, regardless of the market volatility. On the other hand, variable spreads, also known as floating spreads, are the spreads that change according to the market conditions. The difference between the buy and the sell price varies depending on the level of liquidity of the market, the volatility of the currency pair, and other factors. For example, a broker might offer a variable spread of 0.2 pips for Euro USD currency pair during the normal market conditions, but the spread might widen to 2 pips during news releases or other high impact events. Now, let's jump to margin, which is the amount of money that a trader needs to keep in their trading account to keep their positions open. In other words, it is a deposit that a trader must put up to control a larger trading position depending on the leverage used. For example, if a trader wants to open a position of $1 lakh in Euro USD and the margin requirement is 2%, then the trader would need to have at least $2,000 in their trading account to open and maintain the position. Now, let's talk about leverage, which is the amount of money a trader can borrow from their broker to increase the size of their trades. Leverage allows traders to control a larger position with a small amount of capital. It is expressed as a ratio. For example, if a trader has an account balance of $1,000 and the leverage is 1:100, they can control a position of $1 lakh. Finally, we will learn about the order types. But before we talk about that, you should know about the stop loss and take profit levels. A stop loss level is the predetermined price of an asset at which the position gets closed in order to limit the investor's loss on a position. Conversely, a take profit level is the preset price at which the traders close a profitable position. Now, let's jump back to orders, which fall into two buckets: the market orders and the pending orders. The market order is an order that is instantly executed against a price that your broker has provided. So you either buy or sell a specific pair at a given market price. Pending orders, on the contrary, is the order to be executed at a later time at the price that you specify. And for pending orders, you have 4 options: a buy limit, a sell limit, a buy stop, and a sell stop. Now, let's take a look at the virtual representation of orders. First, we will take a look at the market orders. In the first example, we will take a market order buy. Assuming that the market is live, we take a buy at the current market price, which is executed immediately. And as you can see, the trade hits our take profit price level. Let's take a look at the market order sell position. As you can see that the price is rejecting this region. We take a sell at the current market price, which is executed immediately. But unfortunately, the trade hits the stop loss level. Now, we will take a look at the pending orders. To begin with, we will take a look at the buy limit. As you can see that the market has rejected from this zone, so we anticipate that it will reject again from the same level. So we put a buy limit. And once the current price hits the predetermined level of buy limit, the order gets activated. And the trade hits our take profit price level. Now, let's take a look at the sell limit. As you can see that the market has rejected from this zone, so we anticipate that it will reject again from the same level. So we put a sell limit. And once the current price hits the predetermined level of sell limit, the order gets activated. And the trade hits our take profit price level. Let's have a look at the buy stop. As you can see that the market is rising, so we anticipate that it will continue to rise above a certain level. So we place a buy stop. And once the current price hits the predetermined level of buy stop, the order gets activated and the trade hits our take profit price level. Finally, let's have a look at the sell stop. As you can see that the current price is decreasing, so we anticipate that it will continue to decrease below a certain level. So we place a sell stop. And once the current price hits the predetermined level of sell stop, the order gets activated and the trade hits our take profit price level. That's it for today. In the next video, we will talk about when is the right time to trade Forex. And if you want to start trading today, you can sign up using the link in the description below. Forex Kamai signing out.